Thank you all for joining us today despite your busy schedules. I am Ken Tamagawa, CEO of SORACOM. Today, I will walk you through our full year results for the fiscal year ending March 2026 and our financial forecast for the fiscal year ending March 2027. Here's our executive summary. For the full year ending March 2026, recurring revenue grew 41.7% year over year to JPY 9.29 billion, and revenue increased 38.1% to JPY 12.42 billion, both representing significant top-line growth. In addition to solid organic growth, the consolidation of Misora Connect last year contributed substantially. Regarding profit, EBITDA grew 47.3% year over year to JPY 1.22 billion, and operating profit increased 32.7% to JPY 0.8 billion, likewise achieving substantial profit growth. Automation and efficiency gains driven by generative AI have advanced across the organization, improving company-wide productivity. There are three highlights I'd like to share. First, on recurring revenue. ARR at the end of March reached JPY 11.0 billion, with global revenue accounting for 48%, nearly half of the total. Churn remains low, reflecting a resilient, high-quality, and stable revenue base. Second, as global revenue continues to grow, SORACOM's international recognition is increasing. I have exciting news today. SORACOM has been named a leader in the Gartner Magic Quadrant. This reflects the international recognition of our technological capabilities and market presence. Being named a Gartner Magic Quadrant leader is a significant milestone, and we are extremely proud of this recognition. We have also been recognized as a top player by multiple other international research firms. Third, the growth drivers we have been executing, global expansion and M&A, are beginning to deliver clear, measurable results. Building on this momentum, we have established our medium to long-term expected revenue range. We are targeting a CAGR of 30% over 5 years, growing revenue to JPY 50 billion by the fiscal year ending March 2031. Details will follow. That concludes the executive summary. Today's presentation will cover the following topics in order. Fiscal year ending March 2026 full year results. Expected revenue range in 5 years. Fiscal year ending March 2027 financial forecast. I will now walk you through our full year results for the fiscal year ending March 2026. This slide shows the trend in recurring revenue and total revenue. Recurring revenue, as shown in the left chart, grew steadily, with last fiscal year posting exceptional growth of 41.7% year over year to JPY 9.29 billion. The recurring revenue ratio remains high at 74.8%. Revenue, shown in the right chart, was also particularly strong last fiscal year, rising 38.1% year over year to JPY 12.42 billion. In the fiscal year ending March 2026, the results of our growth strategies, including global expansion and M&A, are clearly reflected in the figures, and we are very pleased with this outcome. The scale of our revenue base has expanded, and the various initiatives in our growth strategy have begun functioning as sustainable growth drivers rather than one-off events. This multi-layered growth driver structure forms a solid foundation for continued high growth going forward. Next, I will review the full year results on a year-over-year basis. Recurring revenue and total revenue posted substantial growth as just described. Gross profit increased 22.1% year over year to JPY 6.14 billion. The gross margin was 49.4%, a decline of 6.6 percentage points. This was due to a temporary impact from the consolidation of Misora Connect, which began in August 2025. Misora Connect currently operates at a gross margin of approximately 25%, which is relatively lower within the group. We are working to improve this margin by replacing its infrastructure with SORACOM's cloud-native mobile core technology, a process already underway. SG&A expenses increased 20.5% year over year to JPY 5.27 billion. Efficiency gains driven by generative AI utilization continue to advance, and the SG&A to revenue ratio improved by 6.3 percentage points year over year to 42.4%. As a result, EBITDA grew 47.3% and operating profit grew 32.7% year over year, both achieving record highs. Next, I will compare the full year results against our financial forecast. Both recurring revenue and total revenue exceeded the upwardly revised forecast we announced in February 2026. Gross profit came in slightly below forecast due to higher than expected procurement costs for a large device order. However, operating profit exceeded forecast as SG&A was budgeted conservatively. We are very pleased that both revenue and profit came in above the revised forecast. In the fiscal year ending March 2026, our accumulated growth strategies delivered clear, measurable results and have established the foundation for sustained future growth. Building on this solid momentum, we are presenting our expected revenue range for the medium to long term alongside this full-year earnings report. Let me start with our corporate philosophy. SORACOM's corporate mission is making things happen for a world that works together. Things and people connect, amplify each other's value, and generate futures beyond imagination, one after another. Our mission is to make technologies such as connectivity, cloud, and AI accessible to everyone in pursuit of that vision. In particular, the combination of generative AI and IoT has become increasingly important. Generative AI processes digital information, but to work with data from the physical world, a connectivity infrastructure linking vehicles, equipment, cameras, and sensors is essential. SORACOM can be described as the infrastructure company connecting the real world to AI in the AI and IoT era. SORACOM provides an AI and IoT connectivity platform that makes it easy for customers to connect, and we now serve more than 40,000 customer accounts with ARR exceeding JPY 11.0 billion. Global revenue accounts for nearly half of the total. We are establishing our position as the global leader originating from Japan, a vision we have held since our founding. SORACOM KDDI has been named a worldwide leader in the 2026 Gartner Magic Quadrant for IoT connectivity services. This is the first time a company headquartered in Japan has been named a leader. This represents a milestone we have been working towards since our founding, and we are extremely proud of this recognition. The Gartner Magic Quadrant evaluates companies on two axes: completeness of vision, horizontal, and ability to execute, vertical. Being positioned in the upper right means we have received high marks in both vision and execution. Being named a Gartner Magic Quadrant leader is, in practice, a prerequisite for appearing on the shortlist in RFP processes at large enterprises overseas, opening access to a tier of opportunities that was previously out of reach. We expect this to bring a qualitative shift in our global revenue growth from this fiscal year onward. SORACOM has been recognized as a leader not only by Gartner, but also by multiple research firms, including Counterpoint Research. Please refer to the appendix for additional materials. Next, I would like to discuss the breadth of SORACOM's growth opportunities going forward. Our existing AI and IoT connectivity platform is recognized as a global top leader, and the market for this segment alone is enormous worldwide. We will continue to steadily gain market share, not only in Japan, but also in the US, Europe, and other regions, as we pursue global number one status. As our core platform becomes stronger, we expect it to generate synergies across additional market areas. For example, in services for telecommunications carriers, as SORACOM's platform gains wider recognition, demand from domestic and international MNOs for our state-of-the-art cloud-native mobile core is growing. Second, connectivity is essential for connected cars and next-generation SDVs. Third, AI-native cameras. Demand for AI-based analysis of camera footage is rising. Fourth, AI and IoT solutions. We provide integrated services combining connectivity, cloud, AI, and devices. Generative AI processes digital information, but to work with data from the physical world, vehicles, cameras, sensors, a connectivity infrastructure is essential. SORACOM's connectivity services are indispensable in the generative AI era, and our platform continues to evolve as the hub connecting both the physical and digital worlds to AI. With large addressable markets in each of these areas, SORACOM anticipates continued strong growth. Based on all of the above, let me now explain our medium to long-term expected revenue range. As I have discussed, by leveraging the strengths of our connectivity platform to capture opportunities in the telecom carrier, connected car, AI camera, and AI solutions markets, combined with global expansion and M&A, we have established a management foundation capable of sustained high growth. Previously, our medium to long-term growth policy, under profitable growth, discussed a framework of 30% annual growth plus an EBITDA margin of 10%, totaling 40%. This time, we are presenting more specific figures as our expected revenue range. There are 3 key points. First, in terms of revenue scale, JPY 50 billion in 5 years. Second, in terms of composition, the majority will be organic, with inorganic M&A contributing 20-30%. Third, in terms of profit quality, we are targeting an organic EBITDA margin of over 20%. Starting with our 5-year expected revenue range, we are targeting a CAGR of 30%, growing revenue to the JPY 50 billion level. We will maintain the recurring revenue ratio at 70-80%, preserving the low churn, high retention business quality that underpins our model. Regarding the organic versus inorganic framework, our existing business has a foundation capable of sustaining over 20% annual organic recurring revenue growth, on top of which we will execute strategic M&A to add inorganic growth. Our inorganic pipeline includes domestic and international IoT MVNO businesses, as well as AI and IoT solution companies. Please note that individual years may vary depending on M&A timing. A year with M&A could see growth exceeding 40%, while an organic-focused year may see growth in the low to mid-20s. However, even without M&A, our existing business provides a foundation capable of sustaining over 20% organic growth, which serves as the floor. In any case, we are targeting an average CAGR of 30% over the 5-year period. We also place significant emphasis on profit growth. In particular, we are targeting an organic EBITDA margin, excluding inorganic contributions, of over 20%. As recurring revenue accumulates and scale effects improve gross margins, combined with continued efficiency gains from generative AI, we expect to improve by approximately 1 to 2 percentage points per year, reaching the target over 5 years. We have already seen an improvement of 0.6 points in the fiscal year ending March 2026, and project a further 1.0 point improvement in the fiscal year ending March 2027, with continued progress expected going forward. With this expected revenue range as context, I will now walk you through the financial forecast for the fiscal year ending March 2027. Let me first emphasize 3 points. First, this forecast reflects organic growth only. It does not include any contributions from our multiple ongoing M&A pipelines. Second, the exchange rate assumption is JPY 150 to the dollar. If the current yen weakness continues, this would represent upside. Third, SG&A has been budgeted intentionally conservatively, as we are at the start of the fiscal year. We used the same approach in the prior year and ultimately exceeded the forecast, including an upward revision. We will take the same approach this fiscal year. This slide shows the financial forecast for organic-only recurring revenue and total revenue. Given that the deal pipeline is already building, we are confident in our ability to sustain over 20% organic growth. For the fiscal year ending March 2027, recurring revenue is projected to grow 22.8% year over year to JPY 11.42 billion, with the recurring revenue ratio rising to 75.5%. Revenue is expected to grow 21.7% year over year to JPY 15.12 billion. This slide shows the fiscal year ending March 2027 financial forecast, including operating profit. Recurring revenue and total revenue are as just described. Gross profit is forecast at JPY 7.61 billion, up 23.9% year over year, with a gross margin of 50.3%, an improvement of 0.9 percentage points from 49.4%, driven by recurring revenue growth and cost structure improvements at Misora Connect. SG&A expenses are forecast at JPY 6.49 billion, up 23.1% year over year. Some items have been budgeted conservatively as we are at the start of the fiscal year. Regarding profit, EBITDA is forecast to grow 34.3% year over year to JPY 1.65 billion, and operating profit is expected to grow 28.8% to JPY 1.12 billion, both representing substantial increases. The EBITDA margin is expected to improve by 1 percentage point from 9.9% to 10.9%. As I mentioned, inorganic contributions are not included in this forecast. Multiple pipelines are currently in progress. The exchange rate assumption is JPY 150 to the dollar. We will work hard this fiscal year to build upside and ultimately exceed these projections. The exchange rate assumption is JPY 150 to the dollar. Our FX sensitivity: a 1 yen depreciation adds approximately JPY 40 million in revenue, with a near neutral profit impact of approximately JPY 4 million. If the current yen weakness continues, this could present upside on the revenue side. We will work hard this fiscal year, as we did last year, to build upside and ultimately exceed these projections. In particular, global expansion initiatives are driving high growth rates and represent a key source of upside. Let me now discuss global net sales. SORACOM's global platform is highly regarded internationally, with global net sales ratio already at 40% and 48% on a recurring revenue basis, reflecting sustained strong growth. Global revenue for the fiscal year ending March 2026 grew 32.2% year over year to JPY 4.96 billion. For the fiscal year ending March 2027, we forecast JPY 6.6 billion, continuing our high growth trajectory. The global revenue ratio appears flat due to a temporary increase in Japan's side revenue from the consolidation of Misora Connect. Excluding the Misora Connect impact, the momentum of global growth remains strong. The US market is 5 to 10 times larger than Japan, and the European market is approximately 5 times larger, both enormous opportunities. We will continue to focus on expanding our global brand awareness and gaining market share. Of all our global markets, the US is where growth has been most remarkable. US revenue has achieved a CAGR of 85%, reflecting rapid growth in a short period. One of the key drivers behind this growth is our distributor strategy. Unlike traditional reseller or wholesale models, this is a referral model where partner companies help generate high-quality leads, and SORACOM achieves early closing directly. By partnering with a TSD, a company that aggregates partner networks, SORACOM gains access to networks of thousands of TSAs. SORACOM's services are very highly regarded, and we are able to efficiently cover the vast US market without increasing our direct sales headcount. By leveraging partnerships with globally top-tier TSD partners such as Intelisys and TD Synnex, we will continue to sustain high growth in the US market. The TSA network numbers in the thousands, and we have only penetrated a fraction of that coverage so far. In this fiscal year as well, we continue to place significant importance on recurring revenue growth, and we will build a strong recurring revenue base across both domestic and global markets. SORACOM's churn rate remains low at 0.4%, and our net revenue retention, NRR, is high at 121%. We believe this places us among the top tier of global benchmarks in the industry. Once SORACOM is embedded in a device, it is rarely churned, and as customers' IoT projects grow, revenue continues to accumulate naturally. This is the fundamental strength of SORACOM's revenue base. Unlike typical SaaS models, there is no cap tied to customer headcount, making this a unique model where growth accelerates as the customer's own scale expands. NRR has risen 4 percentage points from 117% in the fiscal year ending March 2025 to 121% in the fiscal year ending March 2026, driven particularly by strong growth in global accounts. We anticipate further growth in the fiscal year ending March 2027, which I will explain using our KPIs. Here are our recurring revenue KPIs. Recurring revenue is the product of average revenue per account, RPA, and the number of paying accounts. For the group as a whole, ARPA is expected to grow 11.9% year over year to JPY 1060K. Growth is continuing even as ARPA scale expands. The number of paying accounts is expected to grow 9.7% to 11,100 accounts. Recurring revenue is derived from the product of these two metrics. I will also cover the global KPIs. Globally, ARPA is expected to grow 10.9% year over year to JPY 2,118K, and the number of paying accounts is expected to grow 14.8% to 2,800 accounts, both growing in double digits. A particular point of note is that global ARPA is approximately twice the group average. This is because in global markets, particularly the US, customers tend to be highly willing to pay for the high-value solutions we provide. Global operations are expected to continue to powerfully lead growth in the fiscal year ending March 2027. Let me also provide an update on our telecom carrier business. In this area, we are progressing through a strategic alliance with KDDI. In the fiscal year ending March 2026, we signed a comprehensive agreement with KDDI, further accelerating our collaboration. As a result, we improved upon the prior pattern of revenue concentration in the second half, and our transaction volume with KDDI for the fiscal year ending March 2026 grew 21% year over year, a substantial increase. Looking at the chart, revenue may appear to dip once in the fiscal year ending March 2025, but last year was an important inflection point. We structured the collaboration model through a comprehensive agreement with KDDI, enabling us to pursue the relationship on a medium to long-term basis. Going forward, we will continue to expand our collaboration with KDDI across key focus areas, including connected cars, mobile core OEM provision, and generative AI and IoT. To drive further revenue growth in the fiscal year ending March 2027, we will continue scaling our key initiatives with KDDI. We are also seeing growing interest from overseas telecom operators in SORACOM's state-of-the-art AI-powered cloud-native mobile core, with multiple deals already in the pipeline, which we will actively pursue. Finally, an update on AI adoption across the SORACOM group. While we have discussed AI adoption at SORACOM itself in previous earnings calls, AI-driven value creation is also accelerating at group companies. At Misora Connect, we deployed SORACOM's generative AI bot Wisora, reducing internal inquiry responses by approximately 70% and enabling staff to focus on higher value-added tasks. Software development at Misora Connect was previously outsourced, but by leveraging SORACOM's expertise, we have achieved software in-house development using AI. This has not only reduced outsourcing costs, but also shifted customer orders to a web-based system, improving convenience for customers. At Carriot, we launched the AI fleet management portal Carriot Copilot, which uses generative AI to automatically generate driver coaching content, supporting higher value operational tasks. As a group, we are committed to AI adoption, driving not only cost reduction and efficiency, but also higher value solutions that contribute to ARPA growth. Finally, let me summarize today's key points. First, fiscal year ending March 2026. Full year results delivered substantial revenue and profit growth. In addition to solid organic growth, the consolidation of Misora Connect drove recurring revenue up 41.7%. ARR reached JPY 11.0 billion, with global contribution rising to 48%. Second, for our medium to long-term expected revenue range, through accelerated global expansion and a combination of organic and inorganic growth, we are targeting revenue of approximately JPY 50 billion by the fiscal year ending March 2031. Third, our fiscal year ending March 2027 financial forecast, based on organic growth alone, calls for revenue growth of 21.7%. Inorganic growth is not included in this forecast, but multiple pipelines are currently in progress and would represent upside if realized. Fourth, SORACOM has been advancing generative AI adoption across the organization, and group-wide AI utilization, including subsidiaries, is accelerating. This is not only driving efficiency, but expanding the scope of value creation through AI and IoT. SORACOM will continue to advance toward its vision as a global platform originating from Japan. Thank you very much for your attention today.